Good morning. I hope you're all very well. It was great to meet many of you over the last 2 weeks while we were on the road. There was certainly no shortage of news to talk about. Some questions we managed to find answers to. Other questions, unfortunately, there just are no answers. The biggest one being, what brand of hair gel do I use? All right, have to be some secrets out there. But it certainly was another whiplash month, the month of October. Markets rallied incredibly strongly over the month of October. You can see here nearly 10% returns from a variety of asset classes over the month. And all of that on the back of just a little bit of dovish news out of the Fed. Some of the Fed members, some of the senators were saying that it might be time to start thinking about a pause. And there was certainly some negative economic data coming out of the US. So bad news for the economy is good news for the markets. And that helped a nice strong rally. The huge outlier, as you can see, is China, down 15% in Rand terms, a horrific month on the back of the 20th Party Congress. And I'll certainly talk more about that later. Is China no longer investable? Is the big question. And we'll try and give some answers to that question. How did that feed into the funds? Well, it remains the three Ds, defensive, defensive, defensive. Healthcare, defensive. Value, defensive, and global defensive as the Rand weakens, all really, whether it's a 1 month or 12-month view, being the big winners in terms of market returns. And with inflation staying high and interest rates continuing to rise, those defensive funds are continue to be the best place to hide. Certainly, they're beating developed market bonds and they're beating gold. And that's one of the reasons why we do like our global equity themes in the face of rising interest rates rather than holding onto bonds or gold. But that's nothing new, you know that view. So it really comes down to the dollar. And that's what the talk over the last 2 weeks has been. Yes, to the end of September and even the first week of October, we had some of the worst returns over that 9-month period in history. Apparently, US bond markets, the worst first 9 months in 234 years. S&P 500 on the equity side, worst first 9 months since 1931. So, I mean, incredibly tough markets out there. Nowhere to hide. Can't hide in commodities, can't hide in bonds, can't hide in equities. Only place to have been really was dollar cash. And we've been diversifying out of dollar cash for a few months now. That has definitely been, we've been too early. But when things get as stretched as they have been, it's just difficult to maintain any sort of risk budget when it is this stretched. This chart is from Alan Gray, and it looks at the fair value of currencies over the last 20 years with a purchasing power of parity model. It basically just says, if you can buy a McDonald's for $2 in this country, you should be able to buy a McDonald's for the equivalent in another country. And if you look at that, you can see incredibly stretched the dollar, the yen being nearly 75% away from its fair value, but also the euro, the pound, everything looking very stretched, and far more stretched than in any other crisis. You look at this chart back to 2008, 2012, 2015, all the various crises we've had in the past. Yes, the dollar has strengthened slightly, but nothing compared to what we've seen now. And the big question is, why has the dollar strengthened so much? If we can understand why the dollar has strengthened so much, maybe we can understand when it's going to peak, when it's going to start to weaken, and what the impact will be on various other asset classes, equities, bonds, gold, Bitcoin, and etc. So the traditional reasons for equities strengthening, for the dollar strengthening in an environment such as we are after the global recession potentially with Russia invading the Ukraine, is safe haven demand. People like to invest in the US. They think it's the safest place to be. So you'll have vast amounts of flows, people buying US equities, people buying US bonds, and that demand for dollars pushes up the dollar. But if you look at the safe haven demand, if you look at flows into US bonds and US equities, they've been very, very mild. Certainly not nearly strong enough to push the dollar this high. The other major driver for a strong dollar is the shortage of dollars. So often we're, again, in a risk-off scenario, when people are panicking, they want to buy dollar assets and they just can't get hold of dollars. And that's very easy to see. You can look at the euro-dollar FX basis spread, and that tends to spike when there's a shortage of dollars. But right now, there's no spike. There's a lot of dollars that are available. So there's no shortage of dollars that's pushing up the dollar. Even with quantitative tightening, which is the Fed pulling dollars into the system and reducing liquidity, there's still enough dollars out there. So it's not the safe haven flows, and it's not a shortage of dollars. Some have suggested maybe it's an unwind of the carry trade, but a lot of the carry trade is done in yen, and the yen's also weakened. So not an unwind of the carry trade. So the only reason that it can be that if you eliminate all the other ones, is the same reason, or the same cause that got Rishi Sunak into power. I'm sure Rishi Sunak thinks that the reason he got into power is because the Liz Truss and Kwarteng put together a banana republic budget, and they were spending too much and cutting taxes at the same time, and it was going to lead to a huge increase in debt, and it would be fiscally unsustainable. To some extent, that was certainly the catalyst. But if you compare that to what the US is doing, the US has got a much worse trade deficit. The US has got a much worse budget deficit. And I'll show you the charts later on. I mean, the US is being far more irresponsible than the UK. But they're the world's largest economy. They're the world's reserve currency. So they can get away with it for longer. I think it's not probably a 5-year cause for concern, but it's definitely something to watch. You can't have a country print as much money as the US is doing without long-term ramifications. But in the short term, the UK couldn't get away with it, and the pound lost some of its value, and US and UK bond yields went up. But that wasn't the problem. The problem was actually hidden leverage in the UK pension fund system as a result of liability-driven investments and the search for yield. So COVID pushed down yields down to zero, and you can't live on zero yields. People were searching for yield everywhere. So a lot of countries around the world and a lot of investors around the world searched for investments that had positive yield, but they wanted to hedge the currency. So that you're sitting in the UK and you wanted to invest in dollar bonds or emerging market bonds. So you had to take your pounds offshore. So you sold pounds and you bought dollars, for example, and you bought the dollar assets. And even if you're buying EM debt, you're probably buying dollar-denominated EM debt. So you're buying, you're selling pounds and buying dollars. But they wanted to hedge the currency, so they did the reverse. Everything should be risk-free because they're investing in this offshore asset, but they've hedged the currency, so all they're getting is the extra yield pickup. But then markets started to fall, and asset prices started to fall, and they ended up with a leverage position where they had $100 in a hedge, and they started off with $100 in an asset, and the asset was falling. So then it had $80 in an asset and $100 in the hedge. So they were overhedged. So they had to unwind the hedge, which means they had to buy dollars and sell pounds. And that is a story that's happening around the world. And that's what's been driving the dollar to such high levels. There's this unwinding of the leverage as a result of the search for yield when interest rates around the world was zero. And it was that exact movement in terms of selling pounds and buying dollars that caused the pound to weaken so much. So the pound got down to nearly parity to the dollar. And that was a result of nearly 150 billion pound losses in the pension fund industry. That was a result of this mismatch and this hidden leverage and absolute panic. And that's why the Bank of England had to step in with quantitative easing and try and stabilize the market. It wasn't the fact that the budget was a bad budget. Yes, it was bad. That was just a catalyst. It was the hidden leverage and the fact that dollars had to be bought and pounds had to be sold to neutralize that position. And that's what we've seen over the last 9 months. As asset prices have fallen, investors have had to unwind that hedge, and they've had to be buying dollars and they've had to be selling their local currency. The good news is that that we have seen the worst in the UK. We've got the new budget under Sunak and Hunt that's going to come up on the 17th of November, and he's promised fiscal stability and economic stability, and so we're going to see a much better budget. But more importantly, that hidden leverage that was sitting in the UK pension system is now out there, and a lot of that has been unwound. There is probably still hidden leverage in other parts of the world that still needs to be unwound and can still cause some economic wobbles. So there's still going to be a lot of volatility out there. Probably in the EU, that's quite a fragmented economy at best. So I don't think we're through the worst, but certainly when it comes to the pound, I think we have seen the lows. The pound has recovered from nearly parity to the dollar, back up to 112 today, and it's likely to move up to 120, 130 over the next in the medium term. It's unlikely to get back to pre-Brexit levels of 160, and that's mostly because the Brexit growth drag is still happening. Brexit wasn't great for the economy, and there certainly is a drag on growth in the UK. But the pound is very weak. The pound is actually weaker pre-Brexit against the dollar than the rand. And that's saying a lot, because we certainly have a lot of issues in South Africa to contend with. So the fact that we've been stronger than the pound over the last 3 years just tells you how much risk is priced into the UK. But we don't think it's going to get back to pre-Brexit levels anytime soon, because Brexit's going to take a long time to sort itself out in terms of actual trade and growth. But it's we've seen the panic lows. I mean, at one point, the volatility in the pound was higher than that of Bitcoin. Now, you all know my views on Bitcoin. I think it's way too volatile to be a store of wealth and a trading currency. But when you get to the point where the pound is more volatile than Bitcoin, well, maybe it's time to reevaluate what a currency is or should be, and whether the Bitcoin is actually now suitable as an investment tool, or whether the pound is no longer suitable as an investment tool. But I think it was a very specific event. It was certainly a black swan event. It was this hidden leverage, and I think that's unlikely to occur again in terms of the UK. So from a dollar perspective, and the dollar being incredibly expensive and incredibly stretched from a purchasing power parity basis, I think the dollar against the pound has seen its worst. So over the last 2 weeks, or particularly in the month of October, but the last 2 weeks of October, we had some dovish statements coming out of the US. There was very good reasons for those dovish statements to come out, and the dollar weakened, and equity markets rallied, and bond yields fell, and it was good times. And then we had the Fed meet on Wednesday this week. And the actual written transcript that came out was also quite dovish. They added in a new phrase, which basically says that interest rates work with a lag, and the Fed acknowledges that there's a lag, and the real-time indicators are showing the economy is slowing quite sharply. And within 5 minutes, the rand had rallied, equities had rallied, and things were looking promising. But the Fed, and particularly Powell, true to form, had a very hawkish Q&A session, and he said it's premature to think about pausing. So all of you investors waiting for the pivot and the pause, it's premature, and markets sold off. And you see in the last 2 days, markets have been quite negative. But I think we're getting very close to the point of a Fed pause and a Fed pivot. And I think it's important, and I think this is very, very important. It's important to position for where the Fed is going to move to. It's not important to position where the Fed has been. I think if you're in position for where the Fed has been, you're going to miss out. And while it's difficult to say whether it's going to be 2 weeks or 2 months, we need to be moving in the same direction as Powell, and Powell is certainly moving towards a pause or a taper. Once again, he surprised on the dovish side in terms of what he's doing. He said that they only hiked 75, and he said the next hike is likely to be smaller, 50. But once again, he spoke up 2023 in terms of the terminal rate hikes. But that's his job. His job is to talk down inflation expectations, talk up interest rates, so that he doesn't have to do as much. The more he can talk, the less he has to do, and the less that actually impacts the markets. So why did we think that, or why has the talk been quite dovish from Fed members over the last 2 weeks? Well, it's the bottom right-hand chart, I think, is the most important there. The red line shows the dot plot, which is what the Feds are predicting the markets to be, interest rates to be. The blue line is what the markets are predicting the Fed's going to do. And you can see over the last 10 years, markets have always said that there's no way that the Fed can hike interest rates as much as they plan to. There's just too much debt. There's not enough growth. It's just the Fed is too hawkish. They can't do it. For the first time in more than a decade, if you look at the bottom right-hand chart, there's a little red circle. For the first time in more than a decade, the markets are now pricing in more rate hikes than the Fed. And that's allowing the Fed to start to actually not be as hawkish in their rhetoric. They can start being more diverse because they've talked the markets to where they want to be. And that's why I was quite surprised that Powell was as hawkish as he was. I thought having talked the markets up to where they want to be, that he could start having more of a balanced conversation. And certainly the written transcript was definitely more balanced. So it was interesting to see that point. But it all boils down to, Powell is restricted by inflation. It has to, that's the bottom line is where we go is very much dependent on inflation. But so how is inflation doing? Inflation is actually looking very promising going forward. The real-time data is definitely showing a lot of slowing in the US. Consumer confidence has plummeted in the US. US housing had the worst August, or had the worst month in August since March 2009. US house prices fell 1.3%. And the reason that we've had one of the reasons we've had such strong inflation in the US is because zero interest rates during COVID pushed up house prices by 50%. And that led to huge positive equity, people feeling very wealthy, and so they were happy to spend. The moment that turns, and it is turning, the moment your home equity starts to fall, people rein in that spending, and that's certainly going to be positive for inflation. So data in the US is looking very wobbly. Consumer confidence, house prices, even jobs. We've got non-farm payrolls later today. And there's, so I suppose, let's say, mixed data coming out of the jobs, but JOLTS is certainly rolling over, and even if you look at within the ISM and job openings, that's actually also looking a little bit softer. So I think we're getting closer and closer to weaker employment, and even if we don't, inflation is still going to roll over. So you might end up having relatively strong employment, but with inflation falling. So why can inflation fall? Well, it's going to fall because the home equity is negative. And people will start spending less, not because they're unemployed, but because they're just feeling a lot poorer. Their retirement funds are down 25%, their homes are worth less. So the wealth effect is going to be the primary driver for deflation in the US in terms of demand driven. We don't necessarily need to have huge unemployment. But let's look at external factors. Energy prices are already falling, so that's great in the US. Food prices have been negative for the last 5 months. Which means that negative food inflation is on the way for the US. Goods inflation, in terms of all the demand supply imbalance because of COVID, that's now falling through. And excluding food and shelter, US inflation was flat in September. So if we've got no inflation besides food and shelter, and food has been negative for the last 5 months globally, and shelter is now negative on a real-time basis, well, then we look at the top right-hand chart, which shows that shelter takes time. It's a lag indicator, but it will feed through. And so we're likely, if not the November number, then the December number is going to show that shelter is starting to roll over. So there's definitely a lot of reasons that inflation is starting to cool, and that's going to allow the Fed to also get closer and closer to this pivot. But there are more reasons to be bullish. And this chart is particularly interesting, and this slide is very interesting just in terms of the energy independence. So and politics. So politics unfortunately drives markets, and the lower that growth becomes, the more the world is dependent on fiscal support and monetary support, the more governments and central banks have an impact. And that's why in this low growth, high volatility world, that's why we're going through purgatory right now. Because growth is low, and we're very much dependent on support from governments and central banks. And every time they open their mouths and say something, markets have a wobble, or they recover. And so politics is driving markets more than economics and more than earnings. And it's a very tough time to invest, and very, very tough time to stay invested and have patience and to deal with all this volatility. So just another example, we've got US midterm elections coming up on the 8th of November. Now, there's obviously a lot of mudslinging going on in the US. Biden is not very popular. Two of the big things he's being attacked for by the Republicans as being too weak on China. And lo and behold, what happened? Well, Biden put out unilateral ban on chip exports from third-party countries and companies into China. Biden being tough on China ahead of the elections. And what's the other thing that Biden is being accused for? He's being accused for having a terrible energy policy, which is leading to the US being dependent on the rest of the world for oil and leading to huge inflation in the US because of that high energy prices. But that's also not true. So the US is now the world's largest oil producer. They have been energy independent for quite some time. They don't need to import oil. The US has cut oil imports from Saudi Arabia by 90%. They're not dependent on Saudi. So the fact that OPEC has pushed up oil prices is a crazy thing for OPEC to be doing. The US doesn't need oil. They are energy independent. The fact that US petrol prices and diesel prices are still high is interesting, but it's an anomaly, and it's driven by margins at refineries. So the refineries have pushed up their margin from $10 a barrel to $30 a barrel. It's a 300% increase. And that's due to some idiosyncratic issues and some supply side and some refineries that are offline. That's going to feed through, and it's also going to lead to lower inflation in the US, which is going to allow the Fed to be more dovish. And Biden's also opened up more federal land for drilling than Trump has done. So the US is becoming more and more energy independent. US inflation is going to come down. It's not going to be held hostage to energy prices, unlike the UK and the EU. So certainly, while we are very bullish on inflation in the US, the UK and EU, while they've seen the worst, they still have high energy prices to contend with. And what's very interesting is that the US is now exporting more energy, more gas to the EU than Russia has ever done. And Germany, as a result, has bought 6 massive LNG conversion plants online in record time. So liquid natural gas is something that's very easy to transport. You put it into ships and you travel all around the world. Normal gas, which is what Russia exports, needs pipelines. So it's very easy for demand and supply for LNG to redistribute because you put it in ships. But for Russia to find new buyers of their gas, well, they've got to build pipelines, and that's not going to happen too quickly. So they can't suddenly start exporting to China or India. So Russia's kind of worked its way into a corner. Meanwhile, Europe, because it's had 9 months to sort out its issues, yes, energy prices are still elevated, and they will be elevated for a while, but natural gas prices are down 60% from their peak. And that's very bullish for the euro. They're through the worst. And if you look at the chart on the right, you can see there that there's actually a glut of natural gas in Europe right now. They were so conservative and they saved so much over their summer period that they're almost at peak storage capacity levels. And the number of ships with LNG parked offshore right now, trying to offload their liquid natural gas, is at a record high. So there's no shortage. And that's also been helped by a very warm seasonal period in Europe. But it's made Europe incredibly ready for Russia turning off its natural gas. But we also don't think Russia's going to turn it off. They've realized that it's not as easy to reallocate that natural gas to other regions. So I think that there's a bit of a stalemate that's happened, and certainly a much lower risk going forward right now, this EU region. And that's important for inflation in the US. It's also important for inflation in Europe. And it's another reason why we think the dollar is going to be weaker, because the last slide was why the pound is now going to be strong against the dollar. This slide is about why the euro is going to be strong against the dollar. Because if you look at how the euro-dollar ratio has tracked, it's tracked energy prices 1-for-1, because the higher energy prices are, the higher inflation is in Europe, and that means the euro has to weaken. But if energy prices are down 60%, and unlikely to see those highs, just because the economies have had time to redistribute and find new suppliers, we're not going to see those highs again, which means the euro is not going to be as weak as it was. And it's just another reason why the dollar fundamentally should be weaker against the euro going forward. And also on the US side, there'll be lower inflation, which means that the dollar can afford to be weaker because the US isn't going to hike rates as much as possible. So Xi Jinping, 20th National Congress, the Chinese Communist Party, and he was re-elected as General Secretary for the 3rd time, and probably for his life. Something that was very well telegraphed, was very well expected, but markets sold off aggressively. I'm sure many of you were caught with eyes wide open as NASDAQ and Process fell 16 or 17% in the middle of October. Now, we're not experts on Tencent, but fortunately we do invest with a lot of experts. Bailey Gifford has a big stake in Tencent. Our active equity managers have big stakes in Tencent, and some of them are overweight Tencent. And we spoke to all of them in length about what's going on in China. And the consensus opinion is definitely that risk has increased, but that the business case doesn't change. And in fact, if nothing else, it cements the large cap, the big players, their monopoly. Because what it means is that Xi Jinping is looking for a stronger cooperation between the private sector and the government sector, the public sector, and he's looking for the private sector to carry a bit more weight and roll out more amenities, which is what South Africa is looking to do as well. Public-private partnerships are very important. So in the short term, maybe slightly lower margins, but in the long term, you entrench the monopolies of those big guys because they can afford to roll out those amenities. And it's something that is already in place, and Tencent in particular has been very, very good in terms of what they've invested back into the community. So the business case is not changing. And if you look at China in general, China has always been a volatile market. Yes, right now, MSCI China is down 64% over the last 18 months. It's looking incredibly cheap. It is the biggest drawdown in history, certainly post a 5-year party Congress. But that China's always been volatile. Why? Because they don't care what shareholders think. They don't care what anyone thinks. When it comes to implementing policy, they just implement it. But that's always been the case. We know that nothing has changed. The big changes in policy happened 18 months ago when Common Prosperity was rolled out. There were no new policies that happened at the 20th Party Congress. In fact, if you look at the written speech in detail, the number of times that the zero COVID policy was mentioned and the number of times that Common Prosperity was mentioned was actually less than 18 months ago when they were implemented. So if anything, it was slightly more market friendly, but acknowledging the move in general for China, which is shown quite nicely in this chart. In general, Xi Jinping, if you look at how the arrow and this bottom line is the number of times that economy, market reform and opening up is mentioned, certainly Xi Jinping is talking about it less than his predecessor. So China talking about reforms less, but it doesn't mean that they are moving backwards. The Chinese market has opened up, equity market, FX market, bond market. I think they're going to slow down the amount that they open up going forward, but they're still going to carry on opening up their markets. They're not closing it. It's just going to be opening up at a slower rate. And I think that is important. So yes, there is risk in China. There's always been risk in China. I don't think it's a new risk, but certainly now that President Xi Jinping has added 4 allies to the 7-member standing committee, well, he can do whatever he wants to do, but he's also always been able to do whatever he wants to do. I mean, it's just how China works. So I don't think it changes the story too much, and I certainly was quite surprised by how vehemently the markets reacted. But none of our active managers, either globally or locally, have cut their China positions. Agreed, none of them have used the dip to top up, but none of them are cutting it. They don't see that the business case is changing at all. As I said, one of the reasons that people got concerned was this China US tech Cold War. That's not going to go away. So I'm happy, that's certainly a big risk. But I think that it's a lose-lose situation. And I think that's the reason Biden did roll out the recent chip ban was because of the midterm elections, and having passed the midterm elections, when we move to a split Congress in the US, there's going to be less anti-China rhetoric coming out. If for no other reason that a split Congress just means it's harder for anything to come out of Congress, and markets in the US do much better if you just break out. historical market returns, S&P 500 returns over a Democratic-driven Congress or a Republican-driven or a split Congress, they do much better in a split Congress. Why? Well, because the government can't break anything in a split Congress because it's much harder for them to put new legislation through. So that's another reason to be bullish risk in terms of the midterms coming up. And also Republicans don't like interest rate hikes. They certainly prefer to protect the wealthy, and that's another reason to be expect a weaker dollar. It's just the midterms, and also another reason to expect less anti-China rhetoric coming out. So, and if you look down in terms of the details, in terms of actual economic growth, China is still stimulating incredibly strongly. Real money supply in China is growing faster than it did during COVID. So they are pumping in the stimulus right now. And yes, that means inflation in 2 years might pick up, but shorter term, before that happens, growth is going to pick up. And we think that they're doing the right things to protect growth. So I haven't changed this chart just because I think it's the euphemism of the year. Not a desirable state of affairs, referring to Eskom. Yeah, no, certainly not a desirable state of affairs. So let me start with some good news. We've got the ANC elective conference coming in December, and there's a very strong probability, I think it's nearly a done deal, that Cyril is going to stay in power, which is very good for South Africa and should help with investor confidence. There's also not as high a probability, but more than 50% chance that he's going to be able to strengthen the top six around him so that he can start driving reforms going forward. And that's also very positive. Then it comes to reforming Eskom. Eskom can be fixed within the next 2 years. And more importantly, the ANC knows they've got 2 years until the next elections. And if elections happen today, the ANC would lose their majority, unquestionably. So they know that if they want to keep the majority, they've got 2 years to fix Eskom. The plans that have been put in place can stop load shedding within 2 years because they've been opening up the private sector so much. So we've got our the Sygnia infrastructure fund. We're partnering with Fairtree on the fund, and we've got some exciting investments that we're looking to invest in. We were hoping to invest in the emergency round, but that got mostly cancelled because of corruption. We've been waiting for over a year to invest in renewable round 5, but that's also red tape has delayed that. But because of the recent changes to the 100 megawatt level, and more importantly, post that, removing the licensing requirements for the 100 megawatts, we are seeing a lot of tenders coming through for the private sector, for the big industrial companies and the big mining companies to raise long-term debt to build their own power plants, independent power plants. And that's very bullish, because not only does it mean that our big job creators can carry on working through load shedding, it means that we can still export during load shedding, and also reduces the amount of demand on Eskom, so that Eskom, even though its supply is dwindling, it'll have to supply less, so it'll mean less load shedding. So that is very positive. Yes, not today, it's going to be a 2-year story. And then the medium-term budget policy statement was also bullish. Again, not today, but 30 billion rand was allocated to SOEs, in particular Transnet. And one of the reasons the rand is weak is because that Transnet can't export, because we can't export because Transnet can't get our goods out of the country, or import goods into the country. And that 30 billion rand should at least help fix Transnet, or at least shore up confidence so that it can raise more debt. So in the short term, positive for SOEs, and that's positive for job creation and positive for growth. In general, it was a good budget, not because of anything we did. We can't take any claim any benefit from that, but it was still a good budget. The tail end of the commodity boom led to revenue being 100 billion rand more than expected, and more importantly, higher inflation in that nominal GDP. So our GDP is, say, growing at 2%, inflation is at 7%, so our nominal GDP is growing close to 10%. That has helped debt to GDP come down. So effectively, we are inflating our way out of debt. And that's why we saw a convergence in the peak debt to GDP ratio move from 75% in 2025 down to 71% in 2023, which is great news. Certainly, we're not going to be upgraded to out of junk anytime soon, but at least we're moving in the right direction. Still, again, nothing that we did as a country, but let's take the win when we get it. So that brings us to the bad news, which is the grey listing. And there's certainly Intellidex says it's an 85% probability. I think it's 100%. Yes, with a whole slew of new legislation has been rolled out, but it's not going to be implemented in time. I think we're guaranteed a grey listing. Pakistan, funny enough, has just actually been removed from the grey list. So they're moving out, we're moving in, and it does impact growth. Hopefully, because of the legislation we put in place, it's only a short term, so 1 to 2 years, and the likely impact on growth is maybe 1%. I don't think it's going to impact our bonds too much. Our bonds are already priced for junk, so I don't think it's going to impact government bonds too much. And it's also not going to have too much of an impact on the big listed equity companies because they generally have global policies and they can handle the extra red tape. But the SMMEs are certainly, and that's what we're looking for huge job creation going forward. Their hands are going to be tied by red tape, and that's where we're going to see shortfall in growth and shortfall in employment, and that's very, very, very sad to see. So we remain underweight SA equities because growth is going to be tough. We remain overweight SA bonds because we have the closest to the highest real yields in the world. We've got a budget that's getting closer to convergence, and we think that a lot of risk is priced in. If you look at the yield gap between South African bonds and US bonds, there's a lot of risk priced in. So US bond yields can continue to rise while ours can actually fall. So it sounds almost blasphemous, but I'm much happier holding South African bonds with a 6% real yield than dollar bonds. We got a -2% real yield, and particularly when the rand is so weak at 18.5 to the dollar. I think you want to be holding SA bonds right now. So we continue to be overweight global, certainly, but we've hedged our currency because we do think the rand, well, not the rand's going to strengthen, the dollar is going to weaken. And we think the rand could some of the wins that the rand could cause. It's definitely a dollar story, but we could have some locally driven rand wins because of the ANC electoral conference in the short term, because of the better budget in the short term, because load shedding could come to a slowdown in the short term. But then 12 months, not 6 months out, grey listing could then be a bit of a headwind on the horizon. So that brings us to positioning, and it's all about the dollar and dollar stability. So let's start with the bottom chart. The bottom chart is quite amazing. Now, I'm not claiming causality here. I'm just talking about correlation, and the chart there shows correlation very, very clearly. So this is a 20-year chart. The blue line is the dollar index, DXY index, and when the blue line falls, the dollar is weakening, and when the blue line goes up, the dollar is strengthening. The red line is world equities over emerging market equities, and you can see there for the first decade, the noughties, the dollar weakened and EM outperformed the rest of the world massively. But over the last 12 years, we had the reverse. We've had world equities outperform EM, and we've had the dollar strengthen. So this does make sense. Why? Well, because 80% of emerging market external debt is in dollars. So when the dollar is strong, and when US interest rates go up, it costs more for emerging markets to fund their debt. And that extra cost eats into profits, eats into growth, and eats into employment. So naturally, when a dollar is strong, it makes it harder for emerging markets to grow. And as the dollar weakens, it makes it easier. Now, yes, the causality, I think, works both ways, and certainly I think stronger rest of world growth also means that the rest of world interest rates can go up more than US interest rates, and it's a bit of a self-feeding cycle, and that's why the cycles do last so long. You've got a decade-long cycle of strengthening, a decade-long cycle of weakening. But if you think the dollar is close to its peak, and I thought the dollar was close to its peak in 2020. I really thought that at that time the dollar was, it almost looked like, look at this chart, we had 10 years of dollar dollar strength, and then it looked like it was rolling over in 2020, and then we had COVID, and that was there. That we now had huge dollar strength. But if you think that we're going to come to a decade of dollar weakness, well, then you probably need to be a little bit less pessimistic on EMs than is priced in right now. People are incredibly pessimistic on emerging markets and China in particular. But if we're heading for a decade of dollar weakness, so maybe you shouldn't be as pessimistic. And why should you long term? I'll get to the short term reasons now, but why long term should you be worried about the dollar? Well, this top hand chart shows why it should be bearish. As I said, the UK's budget wasn't as bad as what the US is currently priced at doing, but the US gets away with it in the short term because it is the reserve currency of the world, and because they are the world's largest economy in dollar terms. China's big in a purchasing power parity basis. But look at this debt. In 2020, looking at $5 trillion in the US. The US federal, the US Congressional Budget Office is projecting that by 2030, that is going to go up 4 times, 400%. You're looking at $40 trillion worth of debt. I mean, the numbers are just phenomenal. The US is just printing money. And that's why we're seeing such huge inflation in the US. They are printing money. People are being paid to sit at home, earning 3 times the minimum wage, as long as they can prove that they applied for an interview, let alone even going for an interview. The US cannot carry on being as fiscally irresponsible as they are right now. And maybe things will get better under a split Congress, but under Biden, they are just printing money. And that can't be good for the dollar in the long term. How can a safe haven currency have negative real rates? It can't. In the short term, it has. It's caught me by surprise. We've been underweight the dollar because I don't know why you'd want to hold dollars when you're getting a -6% real return. I'd rather hold renminbi, we're getting a positive real return. But it is what it is. But longer term, you have to wonder how long the dollar is going to keep its global dominance. Already over the last decade, the dollar has moved from being at 70% of global currency transactions down to, or value held in terms of global currency, down to 60%. And I think that's going to accelerate, partly because of the fact that they froze Russia's dollar assets. So whether you're China or Russia or Middle East, in emerging markets in general, people are going to, those governments are not going to want to hold dollar assets. So that's going to accelerate a shift away from the dollar. But also the fact that inflation is so high in the US, the fact that the US is printing so much money, the fact that US debt is forecast to rise so high, I think we are going to see that move away from the dollar continue. And that's great for the rest of the world. So right now, the US doesn't care about the rest of the world. And a strong dollar is bad for the rest of the world, as I've just said. The US, when the dollar is strong, the US imports deflation, which is great for them, because it means they don't have to rise rates so much. But it also it means that they slow down growth, because particularly EMs, because they make funding so much more expensive. If we get to a point, and we're already starting it, if we get a point where you're going to be buying goods, oil in rubles, or you're going to be buying steel from China in renminbi, if we start trading not in dollars, and if we start pricing commodities in other currencies, it's going to help the rest of the world hugely, just because they're no longer pegged to that when the dollar starts to strengthen and the US pushes up interest rates because the US is being irresponsible, why should it impact your current country? Why should you have to raise rates? Why should you be so constricted by that? And if you're now trading mostly in renminbi or whatever your other currency is, yen, or then you're not as tied to that dollar. So I think right now what the US is doing is going to accelerate that independence. People start moving away from the dollar. And Bitcoin is another great example of that. Cryptocurrency, people no longer trust the dollar. Crypto is another perfect example of that. And there are rumors that China is trying to coordinate a broader EM cryptocurrency that people shift away from the dollar and use that. Whether it's true or not, who knows? But at least if there's just rumors about it, it means that there is a problem. The dollar has got an issue. But it's a long-term story. I think that you need to be worried about the dollar in the longer term. In the short term, why should we think that the Fed is going to carry on being dovish? Well, as I said, midterm elections should lead to a recovery in asset prices, and as asset prices move up, people can unwind those, or start to put those hedges back on, or at least stop unwinding hedges, which is good for a weak dollar. Also, we're seeing lots of real-time weak economic data in the US, which means the dollar should weaken in the short term. And inflation in the US is likely to roll over. So we'll see CPI come out soon, and we've got non-farm payrolls today. I'm not saying we're through the worst. There's going to be a lot of volatility, but I think certainly we've priced in the worst, and we're definitely closer to a pivot than anything else. And as I said earlier, position for where Powell is heading, not position for where Powell has been. Otherwise, you will get burnt. But that's the US. That's why that's from a US-centric perspective why the dollar should weaken. But as I said, for all other reasons, well, a pound is unlikely to weaken because on the 17th of November, we're going to have a better budget. The yen is unlikely to weaken because they've said they're going to protect the yen at 150. It's debatable whether that's sustainable, but at least in the short term, they're going to buy yen above 150 and protect that currency. The euro is not going to weaken against the dollar because we've seen the worst of energy prices. So in all the basket of the trading basket against the DXY index, against the dollar index, looks like they are going to have independent strength. The US is going to have independent weakness, and together that all should mean that we have a dollar weakness, which means that and asset prices should rally, which again will mean that we can start to reverse all the deleverage that's been happening, and that's what's caused us to be in the situation that we are in. And I think a nice data point to look at is Canada. Yes, they're ahead of, they've got probably bigger issues. So Canada, New Zealand, and Australia, their house prices rose more than anywhere else in the world, and they had the highest bond issuance that was variable debt. So certainly they're going to have the highest headwinds in terms of housing prices roll over. But they're the first central bank in the world to say, actually, hold on, our dot plot, our forecast interest rate hikes is too high, and they've lowered their dot plot. Now the Fed now on yesterday or Thursday, Wednesday, we're still talking about raising the dot plot, which caught me by surprise. I thought they'd at least leave it level. Bank of Canada is already cutting their dot plot, which means that we can't be too far. Central banks tend to move together. We can't be too far from the US, at least not raising that dot plot anymore, which again will be bullish interest rates. And as I said before, employment doesn't have to be this. What caused inflation to be so strong in this cycle was COVID, was zero interest rates as a result of COVID, and was the housing boom as a result of zero interest rates, which led to a huge wealth effect, which meant people could just spend crazy amounts on TVs and cars, and they were happy to pay up because they felt so wealthy. That wealth effect's going to reverse as housing prices come off, as mortgage rates are now already at 14-year highs, and that's going to slow down demand. And so demand-driven inflation is going to slow down while employment can remain okay, and supply-driven inflation is going to continue to roll off as US refinery margins revert back to normal, as energy prices at least move sideways, as China slows down, opens up from its lockdowns, and the world starts, and as Europe starts to rebalance its energy supplies and food as well. I mean, we saw this month, Russia threatened the wheat export again, the wheat ban. Food prices ticked up, wheat prices ticked up hardly anything because the world's had a chance to adjust its demand supply. And Russia was forced to come back and say, oh, it's okay, no, don't worry, we'll continue to export wheat because they want to export their wheat. So I think Russia's, they've used all the tools they can from an economic perspective. Yes, they can still threaten World War III and nuclear action and lots of saber rattling, but I think they've done all they can from in terms of influencing global energy prices and global food prices, at least without doing anything stupid, because they do still need imports, import foreign currency, and they're not going to cut off oil because that's all they've got left really is exporting oil, because they can't export natural gas right now. So overall, a dovish look to the dollar. And as I said, although we are overweight offshore, we do have some hedges on the rand. So two more reasons why we think that we remain bullish. And again, we have used this bounce. So markets have bounced very nicely from their early October lows, and we've had a 10% bounce in October. And we did actually we put on a position over equity weight position, which we have cut. We've locked in those gains. So volatility is here to stay, but generally we think we're closer and closer to an end of year rally, at least a 3 to 6 month bullish view. And two more reasons. Well, one is the chart on the right, which just shows that the investors are the most conservatively positioned, most hedged, and have the highest cash holdings they've had in 20 years. So when everyone is this conservative, and when growth is still okay. I mean, we saw 4% growth come out of the US GDP after 2 quarters of negative growth, a technical recession. They bounced back. So we early in the rates hiking cycle, equities and risk assets normally actually rally in the early part of rate hike cycle. Yes, it's been the fastest increase in real rates in 20 years, but we still are early in that cycle. Growth hasn't been destroyed, but investors are very negatively positioned. And I think what helps me sleep most at night is the fact that long-term inflation expectations remain anchored. So we're not in the 1970s. Volcker had to raise rates to 20% to crush inflation expectations, which are out of control. Inflation expectations are still anchored. They're still within the Fed's band, and as long as they remain anchored, the Fed doesn't have to do anything crazy. Yes, they can talk up as much hawkish rhetoric as they want, but so far they've actually been dovish in what they've been doing, and I think they can continue being dovish in what they're actually doing because inflation expectations are anchored. So the Fed needs to talk up rates. They've done that. The Fed needs to talk down inflation expectation. They've done that. Growth is still okay, but the negative falling house prices will certainly help remove demand-driven inflation, while supply-driven inflation is also rolling over. So things, yes, it might feel like a bit of a Goldilocks scenario that I'm painting, but there are risks and things can still work against you, and there are still black swans that exist. But the way the pieces of the puzzle are fitting together, the way the data points are aligning, we are closer and closer to a pause and a pivot, which should be good for all asset classes. And while we remain negative on global bonds and we remain negative on Bitcoin and gold, every asset class is going to rally into this pause, because US interest rates are the starting point of the cost of money for any asset in the world. And yes, over the next 5 to 10 years, that's going to change, and it is certainly changing. People are moving away from the dollar. But right now, if you want to price the cost of investing, whether you're buying a house or whether you're starting a new project to expand a mine, or whatever you're doing to spend money, when it comes to what is your cost of capital, your starting point is US bonds. You add on a country risk premium, you add on an inflation risk premium, but the dollar is the driver of world cost of money. And that's why we've had such a negative year, because the cost of money around the world has gone up. In the short term, I do think that cost of money is going to go down. It's because the Fed can afford to pause. In the long term, that cost of money is going to come down because we're going to move away from the dollar. But that's a long-term story, and But then again, investing is a long-term game. You buy equities for a 5 to 10 year view. So it's also good to remember that. So that's why, when it all comes down to it, we like our themes, because we remain in a low growth world. We've got debt at all-time highs. We've got demographics that are aging. We've got decarbonization, which is a new threat to earnings, and deglobalization, which is also a headwind to growth. So when you've got those 4 headwinds, you need to find 4 themes, and we've got our 4 themes, and they work. So basically, find the theme that's negative, and we invest in the opposite of it, which should benefit. So decarbonization, you invest in sustainable economy funds, because while yes, people being forced to move to solar is going to be a cost to earnings, and people being forced to having to filter the pollution that comes out of their factories before, and price in that cost. Well, buy companies that are producing solar panels or producing new carbon filters, and that's what our sustainable economy ETF does. So that's why we like sustainability as a core theme going forward. It will continue to grow just because it'll benefit from the headwind that's coming to the rest of the world. In the same way that we think that aging populations are a headwind to growth, because growth is made up of productivity and labor supply growth. And labor supply growth is falling. It's been negative in 20 years in Japan, negative for 10 years in Europe. It's negative now in China, and it's going to be negative in 5 years' time in the US. Well, invest in healthcare, because healthcare benefits from aging populations. So again, what's causing low growth around the world? Find something that's working, and healthcare works well for that. So then we have our two other ones, deglobalization and debt. Well, that's what brings us to our final two, which is in terms of deglobalization. Well, you need to actually invest in other parts of the world. So we see, right now in the world, there's 60% in the US, and China has 4%, but the next billion emerging consumers are coming from Asia ex-Japan. Yes, right now it feels very tough to invest in emerging markets in Asia ex-Japan, but that's where the growth is coming from. And if markets are going to become more deglobalized, you can't rely on investing in a Richmond or a US company that sells to China, because deglobalization is going to actually reduce that revenue supply. So you've got to invest directly yourself into other markets, and that's how we like having China as a theme, or emerging markets as a theme. And then the first one, which is huge debt's going to, we're not going to be able to grow out of our debt theme, because all the benefits we had in the 70s and 80s of increasing labor supply, because women entered the labor force, because social security meant that more people could enter the labor force, all of that's gone away. And in fact, it's become headwinds. So when the world is going to slow, when growth is going to be slow, because traditional businesses are going to grow slow because of huge debt, or you invest in technology, because you're going to find companies that can still grow in a low growth world. That's why we launched FATF. It was our first theme. We knew that growth was going to be low. We had to find places for growth. So yes, we don't like bonds. We don't like gold. If you know the story, we don't like Bitcoin. We've got these 4 themes that will continue to grow over the next decade because of these 4 headwinds that are going to make growth slow in the rest of the world. And we continue to think that is how you should position your portfolios, and that's certainly how we positioned our funds. So equity allocations across all our balanced funds have access to these 4 themes. Yes, healthcare's worked beautifully right now. Yes, 4th IR or tech and emerging markets haven't worked that well. Our sustainable fund has actually worked beautifully since we put it on, but that's a shorter term, but it's up very nicely. So, but we've got sustainability, healthcare working well, whereas EM and 4th IR tech not working as well. Fortunately, we had a short-term strategic theme, which was value, which is more a cyclical theme, because you only invest in that when interest rates are rising, and that has worked well. We did our big change to our funds over the last month is we have reduced we still overweight value, but we have taken some profits on value, and we do think we're getting closer and closer to growth rebounding. Yes, we were too soon in terms of topping up 4th IR, just like we were too soon moving out of the dollar, but we do think we're getting closer and closer to that point. And this slide you all know very well. No changes there. So let's take some questions. Sure, that was an hour. Okay, so we'll have to see how many questions we can squeeze in. Okay. Wayne asks, do you think the grey listing will have a detrimental impact on the rand? Yes, I do think so. Certainly. I think at the same time, in the shorter term, the rand's going to strengthen because of a weak dollar and the positive ANC electoral conference, but definitely grey listing negative. Mervyn asks if Sygnia uses hedging in our balance funds. Yes, we definitely do so. It was one of the major benefits of running a balance fund, is we can do what you can't do if you blend an equity fund and a bond fund yourself. We can overlay, we've got the cash that sits there from the money market that can be used to fund margin, to overlay hedging. So We did it very successfully with NASPERS and Process when that was 30% of the SWIX. We put on zero cost hedging, which worked very well. Right now we are hedging the rand with a variety of different instruments to protect against rand strength. If it doesn't work, we'll have to close that out. But the important thing is when it comes to hedging, we do it in small tranches and we do it using derivatives, which have very, 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 very low transactional costs. So even if we get it wrong and we get out, the impact is very low. Christopher points out that the sterling has been weaker, has been stronger to the pound. Yes, Christopher, I agree with you. If you look at the long-term story, the pound has definitely not been as strong as the dollar, and I think that talks to my secular story about. And again, maybe this is a 50-year story. You've had, if you look back over thousands of years, you've never had one region dominate forever. Whether it was China that was strong at one point, or the UK that was strong. The UK gave up its global dominance to the US. And I think the US global dominance is waning, and I think they're going to hand that over to China. So yes, I mean, over the last 50 years, the dollar has been the strongest currency against any economy. Yes, the pound is certainly past its peak. And the pound is actually just like right now, the pound is being priced as an emerging market currency. So is Europe, so is the yen. In fact, all countries are being priced as EM currencies besides the dollar. But I think also, need to look at what's happening in the US. And I think if you just look at how responsible China's being right now in terms of how they're managing their current account deficits, their budget deficits. And how strong they're growing, I think that we are probably seeing the end of US global dominance. Yeah, Christopher asks again if there are headwinds for inflation in the US, and certainly there are some headwinds, and that's one of my themes. So deglobalization means onshoring, and that certainly will lead to some inflation in the US. There are lots of counters to that. The US has not. In terms of how industrialized the US is far behind China and Japan and Korea and other countries in terms of the use of robotics. So the US can get its expenses down, or at least its manufacturing costs down, by moving more into robotics and making it more automated. At the same time, if the US stops, I think it's very likely to come soon after midterm elections, the US stops printing money and paying people to stay at home 3 times what they should be earning. I think that wages at the lower end will also stop rising. So yes, there are some inflation headwinds from onshoring, but I also think there's some deflation headwinds that make it more of a balanced story. So Don asked a great question. What effect is future dollar weakness on Sygnia ETFs and South African bonds? So dollar weakness means rand strength, and that's very good for South African bonds. That's why we overweight South African bonds. In terms of being offshore, and this is that's why it's easy for us. Well, I suppose it's easy, but it's hard. You don't know if you're going to be right. But we are overweight global, so we overweight our Sygnia ETFs. We overweight our global themes. We've got 35% in terms of global exposure, but we've hedged the currency. It's a bit more nuanced if you want to buy the Sygnia ETF, like the Sygnia S&P 500 ETF, Sygnia US ETF on its own, because yes, equity markets should bounce, but the pound and the rand's going to strengthen. So those are going to offset each other. It is a bit more difficult when it comes to that. But my baseline over the next 3 to 6 months is that all prices are going to rally, and certainly equity prices will rally more than the rand strengthens. So I think it doesn't matter where you invest, you're going to do well. But you'll probably do better out of South African equities and South African bonds just in the short term if you can't hedge the currency yourself. Alex asks a great question. Would you buy China right now? So as I said, looking at all the experts, they're all sitting on their hands. I think that China right now, again, if you don't have any exposure, let's put it this way, it all boils down to managing risk. And the risk has increased in China, but so I think has the expected return. So if you are prepared to sit through more volatility and you're prepared to take on higher risk, then certainly I think it's a great time to buy China. In terms of our balance funds, we've actually cut our China position slightly, not a lot. We've cut it from we've cut it by about 15%, but we're just managing risk. Volatility has increased, and so even though our expected return has gone up in China, so has our expected risk, and so we've cut that position slightly. So it all depends on how far your time horizon is and how much risk you can take on. We still very much believe in that theme. Our fourth theme, the emerging Asia, a billion consumers, is not going away. China plays a big part in that. So, if you're prepared to take on the risk, I think buying right now makes sense. That said, as I said, we're cutting our model weights because the risk has gone up and you've got to balance risk and return. Louise asks, how would Sygnia's investing in infrastructure feed through to Sygnia funds or ETFs? So that is a great question. So unfortunately, there's been no solution to how to best invest in infrastructure because infrastructure is not liquid, and most regulations, particularly in unit trusts and ETFs, the regulation is there to protect investors and to make sure that investors can sell their holdings, which means that underlyings have to be liquid. So regulations are protecting investors, but at the same time, they're making it impossible for a unit trust to invest in a 20-year investment because you can't sell it and you can't provide liquidity if investors want to get out. So right now it's quite difficult. Fortunately, on the retirement side, whether it's a retirement annuity or a living annuity or an endowment, which is a longer term time horizon and the regulations are a little bit more relaxed, there you can invest in 20-year instruments, and certainly that's where our investments are sitting, and we certainly will look where the risk returns look appropriate. We'll switch into some of that debt out of other debt, and so we have our credit fund already; it's already there. But, we might switch out of whatever we hold in terms of debt instruments. Maybe it's a growth point instrument and we'll switch out of, although growth point at the same time can also be considered infrastructure. So maybe that's a bad example, but we'll switch out of some debt into infrastructure debt in those funds. So it will lead to a slight divergence between our unit trust balance funds and our life balance funds from a regulatory perspective. Yes, Christopher asks again. Christopher, maybe you should come and present. But he says South Africa real yields are going to stay high. I agree. I'm not saying they're not going to go back down to 8%. They were, we remain junk debt. We're not going to get back into the WIGB and other indices, and we have to keep our rates relatively high to attract capital. But they don't need to be as high as they are. They can easily come from 11% down to maybe 9%. Not going to get to 7 or 8%, but they are going to strengthen, and that's going to lead to capital gains and integrate great yield. Hannah asks, what is the difference between the Sygnia Skeleton International Equity Fund of Funds and the Sygnia Skeleton Global Equity Fund? So the Sygnia Skeleton International Equity Fund of Funds is a unit trust fund that invests in 100% global equity, and it's passive and invests in our themes. The Sygnia Skeleton Global Equity Fund, I think you're thinking of the Skeleton Global range, and that's on our life license. So that's for endowments and living annuities and retirement annuities. So that's exactly the same fund as just in a life license on a unit trust, but the same model portfolio. It's identical. So those two funds are identical. Yes, Kubus asks, is Brexit responsible for the current economic crisis in the UK? Certainly. There have been a lot of bad decisions made in the UK. The biggest is certainly Brexit. That is definitely the one that's impacted their growth in terms of trade and attracting talent and increased regulations. and that they certainly haven't sorted out Brexit yet. It was the worst decision that they could have made, and they're still living with it. So everything else is pretty minor compared to Brexit, and they're not through the worst of Brexit. But we still are overweight FTSE 100. The FTSE 100 is not a very UK domestic centric index. It's a global index, and we continue to like that ETF. John asks, which specific commodities are we invested into? We don't have any direct exposure into commodities. Commodities are difficult to invest into. Generally, you have to invest into commodity futures, and you have to worry about backwardation. You have to worry about the roll, and the spot returns don't at all reflect what investable returns are like, and it is difficult. And there are a lot of products out there, and some of them have leverage, and some of them have fancy roll structures and contango and backwardation tools, and it can get quite complex. We don't, because we still have our largest exposure of any asset class of South African equities. South African equities still have a very large exposure to resources, so we're quite comfortable with getting enough resources through our SA equities. And it's one of the reasons why we haven't gone to 45% offshore. I think if we had to go to 45% offshore, we'd hold less SA equities, which means we'd have less exposure to resources, and at that point we might actually have to invest in either global commodities or a global resource index. So we'll get to that decision when we get to more offshore. Alex asks, what is your take on buying Sygnia money market versus buying South African bonds? Excellent question. Again, all the depends on your risk and your time horizon. So if you look at the Sygnia money market is incredibly liquid. I think the yield at the moment is about 6.5%, maybe at 7%. And it's a great return as interest rates have gone up. Very liquid. And that's great if you've got a short-term, 6-month time horizon. If your time horizon is a little bit longer, maybe a year, Sygnia Enhanced Income is awesome. That's our credit fund, Sygnia Enhanced Income, which is a unit trust which invests in credit, is 3rd out of 110 over the last, I can't remember, maybe it's 7th. I can't remember exactly. The performance over the last year is incredible because it has very low volatility and it's got no bonds and no property, so it's been very defensive. So if you want to live off your capital over the next year, some money market's great for short-term liquidity, but some investing into enhanced income, which has currently got a running yield, so current yield, not 12-month return, but a current yield of about 9.5%. So you can earn 9.5% with very little volatility. But that said, if you are like me and you think that the rand is going to strengthen and you think bond yields are going to come down, well, you might be able to get 15% of the bonds over the next 12-month period. But it comes with risk because, like we've seen over the last year, bonds, even though they had fantastic yield over the last year, and we've been very bullish, and you get 12%, 11% yield, you can also have capital fluctuations. So as long as you're only spending that yield and you're not eating in your capital, bonds have been a fantastic asset class, but not great if you want to spend capital, because then you have your total return has been 2 or 3%. So if you don't need to spend capital and you have a 2 or 3 year time horizon, bonds are the clear winner. If your time horizon is shorter, maybe a year, then you're going to, instead of getting 15%, you're going to get 9.5% enhanced income. If your time horizon is shorter, 3 months, or the money market, you're going to get a 7% income. So your investment depends on your time horizon, which depends on your risk. When it comes to investing, the most important thing, yes, there are many things that impact your asset allocation decision. You have to worry about your risk budget. You have to worry about your funding levels, as in how much surplus savings have you got. But your biggest one is your time horizon, which is certainly the overarching decision. Sean asked, at what point do you think we're going to see growth come back and EM come back? It all depends on when. So everything's going to, if we see a pause, if we see US bond yields start to roll over, it's going to lead to a massive, basically the cost of money comes down, it's going to lead to a huge bounce in all assets. But I think the fastest bounce is going to be in the ones that are most oversold, which is emerging markets and growth, which is 4th R and tech. So the things that have done worst over the last 12 months will bounce the fastest. And then you'll probably see healthcare and value, they'll probably still give you good returns, but they won't up as well as everything else. Sean asks, how would you manage, and another great question, your exposure to thematic funds in portfolios? Again, it talks to your risk budget. So our question, so if you have to invest in any of our balanced funds, whether it's skeleton or signature or skeleton balanced or CPR range, or our global equity funds and the life license or the unit trust, or they all have the same portfolio, and it's roughly 20% satellites, broken down, so say roughly 4% in each of the five themes, and 8% into the core index weights. And then if your clients are prepared to take on more risk, they can have a higher weight. You can add on to that with more of the themes, and you can pick which theme you like the most. But that all depends on the risk appetite of the client. And that's important. And if your client doesn't like any risk, well, then you just buy the SIG World or our SIG ESG, which is the World ESG Fund. And those are pure passive benchmark trackers with no themes at all. So, if you want less than 20%, you have buy our equity funds with some SIG World or SIG ESG. And if you want more, you buy our equity funds and you add in some of the themes. So it all depends on how much risk you want and how aggressive your clients want to be. And that also depends on their age and the time horizon, as I've said, their funding levels and their risk appetite. James, can sharks swim backwards? I think I'm missing your point there. A great point. We're living in an age of permanent crisis. Let's stop complaining. Let's stop planning for a return to normal. And I think that's the source there is the Guardian. And I think that's exactly what I'm saying. 5 years ago, we transitioned our funds to be positioned for a low growth, high volatility world. We're living in an age of purgatory. So that's what it is. It's very sad, but that's what it is. We had 40 years of heaven, of just golden abundance and surplus, as the cost of funding, as I've said, the US interest rates went from 16% to 0%. As that cost of funding went from 16 to 0, the pricing of every asset class dropped, the cost less to borrow money, and so you could just, everything re-rated massively. Housing, gold, cryptocurrencies, equities, EM, whatever, everything went up. We're not paying for that. We're paying for the abundance. We're paying for the excesses of the previous generations, and for the next 20 years at least, until we get debt down to more manageable level, until we grow out of our debt, until interest rates stabilize, we're paying for that. We're in purgatory, and that's the best case scenario. It's going to be purgatory with bouts of hell like we had during COVID, and the bounces when the stimulus from governments. And it has followed our theme perfectly. I mean, our theme from 5 years ago was Japanification. That theme has lived out. Japan has been in a 30-year period of sideways moving markets. Yes, you still need real assets, but you have to be very nimble. You have to have tactical asset allocation, and you have to trade the bounces because growth is a lot harder to find. And we think more importantly than trading the bounces is to find growth that will exist in a low growth world, hence our themes. Bradley asks, Kyle, do you think the dollar's reached its peak? Yes, I do. I got it wrong, so maybe you shouldn't listen to me. I thought it was 3 months ago. We rotated out of our dollars into, well, we've been doing it fortunately slowly. We do everything. We do it on tranches, but I believe the dollar has reached its peak, and I'm giving all the reasons why I think it has. Yes, there are reasons that we could see dollar strengthen again. If inflation continues to blow out in the US, the dollar can get to new highs. I don't think that's the case. I don't think inflation is going to blow out, but economists could continue to be horribly wrong. They have been over the last 2 years. That we could see that's certainly a risk. Yes, skeleton funds adopt the same, all the thematic themes. From Chris. Akbar asks, you're fairly overweight South African equity in your balance funds. We're not. We're underweight our benchmark. So our high risk funds have 45% SA equities, which is 3% below our benchmark. So we're not overweight SA equity. It is our biggest asset class. So it's from an absolute sense, not from a benchmark sense. It's our biggest overweight, it's our biggest exposure. I give you that. Why? Well, because people generally aren't going to immigrate. So people generally, their liabilities on rands, and when you're matching assets to liabilities, well, you need rand assets. And also, South African equities are the cheapest they've been in 100 years. And that's something that, again, we are going to get more offshore. People ask when we're going to get to 45 offshore. We will get there. We want to get there because that's what diversification requires. But in the short term, SA equities are very, very cheap. And we need to manage that move in a prudent manner. So our biggest allocation is to SA equities. But I think even when we get to 45 offshore, our biggest weight's still going to be to SA equities, because when you do all the fancy modeling, when you need to match your liabilities in rands, and you can have periods, we forget because we're going through right now, but you can have periods where the rand strengthens for 2 years in a row, about 30%. If you have all your money offshore, you need to live off that income, and we've got a 30% capital loss, you're in trouble. So when you're retiring in rands, or when you're saving in rands and your liabilities on rands, it's very important to model all your portfolios in rands, and then you have to have the majority of investments and at least 55% in rands. You can try and get more clever, and you can start modeling your current assets, which should be all in rands, and your surplus assets should be all in global funds. But you need so many assumptions to work out that. I mean, you've got to know how much money you're going to spend before you die. I don't know how much money I'm going to spend before I die, because you don't know what inflation is going to be. You don't know what medical expenses you're going to have. You don't know what holidays you're going to go on. You don't know what your family's going to do. I mean, there's just so many unknowns to try and work out what your surplus assets are is very difficult. Unless you're a billionaire, and then go for it. And then if you're a billionaire, you probably have all your money offshore anyway, because then you probably won't run out of money. But for the rest of us, you have to worry about running out of money. Serena asks, fourth hour, would timing be right to add to one position now? As I said, we've got that wrong. We topped up in Jan. We topped up again in August. We're still not at the maximum weight, and we think we're getting closer and closer to that inflection point. But from a fundamental perspective, fourth hours never look better. Earnings are strong, pricing is looking good, and it's a great theme. Vilhan asks about India. We do like India. We haven't got a separate standalone fund for India, just because we don't think it's liquid enough yet. But our EM fund does have exposure to India, and we do like, as I said, we like the whole Asia ex-Japan as a theme, and India definitely forms a big part of that theme. Krista asked about the euro. I think the euro is also going to strengthen, just because it's past. Euro has its own issues, just because it is a monetary union without a fiscal union. They're always going to have problems, and that's why they haven't taken over as the reserve currency of the world. That said, being past the peak of the energy crisis, I think we've seen the worst of the euro. Bradley asks when we're going to launch our structured product. Great question, Bradley. We're itching. We've got a very exciting structured product. We're just sorting out some compliance and regulatory and administrative issues. And hopefully we'll have something exciting there for you soon. Chris asks about our oil price outlook. Yeah, as I said, refinery margins are very high, so I think a tailwind to oil energy prices coming down is refinery margins lowering. China's about to export a huge amount of oil. That's also going to be negative for oil. OPEC Plus, they said they're cutting production. OPEC Plus is a myth. You look at they talk a big talk to try and talk up and down the oil price. Look at their production. They can't meet their production targets when they increase them. They can't cut back when they say they're going to cut back. They talk a big talk, but they are victim to their own realities when it comes to pumping oil and influencing the countries within it. So they never got to. They promised to increase supply. They never got to the levels they promised to. They've not cut supply. They're not going to. They can't. They're not going to. It just means they're getting closer to what they're currently producing. So look through OPEC. Well, yes, there are still risks in terms of Russia to the oil price, but the energy market is rebalancing. US is increasing its supply, and I think that oil is probably going to move. And it sounds like a lazy answer, but it's going to move sideways. I don't think it's going to fall off. You're not going to get back to $60 a barrel. But you do have Saudi producing at $22 a barrel, and you've got Russia producing at $44 a barrel. US shale gas is about $65 a barrel. And so when you're that far above the producing levels, you're going to encourage additional supply, and that's going to replace. It takes time, but we are 9 months down the line from Russia invading Ukraine, and that means that more supply will come online, and it'll keep oil at least honest, and probably around $90 to $100 a barrel. But even if oil moves sideways, inflation on oil is zero. Ricardo asks if current rates are going to feed through to the labor market in the US. Now, there's definitely a chance of recession in the US in 18 months' time, maybe even 12 months' time. I said there are a lot of tailwinds right now to inflation, but employment is not one of those. And if employment stays strong, we might get, US inflation might fall down to 4%, and in 12 months' time, the Fed realizes they need to raise rates further to try and get the labor market to behave, and then we could have a recession in 12 to 18 months' time as a result in the US. So while we're bullish in the short term, there are certainly clouds driven by the labor market in the US in the longer term. Mervyn asks what proportion of Skeleton Balance 70 fund is offshore equities. 26% is global equities in the 70 fund. 35% is total global with a hedge. 26% is global equities. 27%. Rachel asks what kind of infrastructure investments we're investing in. We're investing in bonds. We don't like equity. There's a lot more risk in terms of implementation risk. We prefer the bond exposure. Tom asks, what are the, assuming we've hit world growth peak, what are implications in direction of future markets? I still think that Japanification is our best theme. Yes, there's been deflation in China, whereas now there's inflation in the rest of the world. And it is good. Inflation does help us grow out of debt. But I still think that our 4Ds are going to keep growth low, which means that equity returns are going to be a lot lower than they were in the past. Mervyn asks, if you were only looking at returns and not worried about risk, would you do emerging markets or China? Well, certainly there's a lot more risk priced into China. So if you're not worried about risk, and China's been pricing in a lot more risk, whereas India has been quite defensive and other parts of EM have been quite defensive. Well, there's probably more upside in China if you're not worried about risk. But there is a lot of risk in China. Justin says, what are, in your opinion, the best equity funds to invest in with the highest risk return reward for the next 5 to 20 years? If we knew that, Justin, we would put everything into that and we'd have exposure to one investment. But unfortunately, it's very hard to forecast returns. Surprisingly, risk is quite stable. So the volatility of various sectors and various countries is actually quite stable. So you can use your correlation and covariance matrices to give quite a good forecast of risk. But returns are very difficult to forecast. And that's why we do diversify, because we can diversify the risk quite well, understand risk, and that's why you end up with a portfolio that has a lot of exposure to different things. Certainly, if you had to assume, there's lots of ways of doing it. If you had to use can't remember the exact terminology, but if you had to optimize, again, with models, it comes to garbage in, garbage out. But if you had to optimize and assume the same return from different equity regions going forward, and just use your risk as a tool to get max, I think it's called maximum diversification as a portfolio construction tool. So you return agnostic. You would certainly have a lot less US right now and a lot more equally weighted portfolio than you would. Yes, there would be, EM would be lower because it's got higher risk, but you certainly would have a lot less US than is in the index. And you'd probably have less resources because it's got higher volatility and such like. But over 5 to 20 years, it all depends on your return assumptions. Yeah. And that's difficult to do. I still think it's fair, and if you look at what various strategists do, it's still fair to assume that emerging markets will give you a better return than developed markets. It's because growth is higher, because there's more urbanization that needs to happen, because there is the next emerging billion in EM Asia, ex-Japan. So I think that's fair, but I must admit, when it comes to our modeling, I'm not brave enough to do that. I just put an equal weight in terms of expected return. And that's why we have less EM than we do developed markets. So it's a great question. It boils down to your modeling. With modeling, you can get whatever you want. Oh, sorry, Justin then qualifies the question with best RSA equity fund. Justin, I'm not an expert. We do invest in active equity managers. I can't tell you which one's going to have the best returns over the next while. In terms of, if you want to start predicting divvy versus the actual broad index, I think the divvy should outperform the broad index over time, but it's not going to be a massive outperformance. It may not, the divvy right now is great. I think it's the second best general equity fund over the last year, and you're paying 0 fees. It's very hard to ignore a fund that is the #2 fund in the country at 0 fee. That's pretty exciting. But again, I would diversify, because to pick one fund is tricky. Tom asks private equity. So at the moment, we only have Oxford Sciences Enterprise as our PE, but private equity fund. We still love that. We think there's a lot of upside in that fund. Yes, it's been hurt in the short term because it is denominated in pounds, and the pound has weakened. But as I said, we expect the pound to strengthen, and that should lead to not only, and we also expect OSE to value on the upside. So you're getting a double whammy on the upside going forward on OSE, and we do like it. It is open to investment. And we do think that's a very attractive asset class right now, and so I would definitely say that it fits into our healthcare theme, and small parts of it also fit into our disruptive technology theme, but it's mostly healthcare at the moment, we still have a very large allocation to that, and we're very excited about the outlook for that fund. So definitely, that's a good place to be. Yes, I think that's about it. We're 12:30. Thank you very much, everybody, for dialing in. I hope you have a great weekend, and good luck with the investments. Hopefully we have a strong November, and we can have some positive things to talk about when we meet early December, and our client conversations start to become a little easier. I feel your pain. You've got returns that are roughly flat over 1 year. It is difficult to have those conversations. But we certainly are feeling bullish. We think there's a lot of catalysts coming up to look forward to. We've got midterms, we've got the US budgets that are coming, with the ANC elective conference, and we think there's a lot of positive catalysts coming. We've got positive seasonality, and hopefully at some point soon we also have a dovish pivot. And so that should be good. Of course, it can all be completely thrown out the water by a bad US inflation print. So it's still dangerous out there. Stay cautious, stay nimble, and have a good month.